Hey climbers, welcome back to Climb by VSC, a weekly show about building and scaling startups in the world of climate innovation. My name is Jake Kapoor, general partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak with a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've all heard enough of the doom and gloom. It's time for stories of purpose-driven innovation that lead to sustainable, positive change. As always, I'm so happy that you've decided to join us. Now let's climb.
Hi, everybody. Welcome to another episode of Climb by VSC Ventures. I'm really excited today to have a longtime buddy on the show, Ryan Gembala of Pathbreaker Ventures. I met Ryan, I want to say 10 years ago in an office for Telly. Why don't we jump into it? Tell us about give us the thesis for Pathbreaker. Why did you leave? I think you left Facebook at the time, right? To start Pathbreaker. Why did you start the fund? And tell us about what you're looking for in the thesis.
Sure. So Pathbreaker is the manifestation of a career spent across what I think of as the three pillars of the company building process: building, funding, and achieving liquidity. At Facebook, I worked on the liquidity side as a deal lead on the M&A team. So I was one of a handful of people at the time in 2014 and 15, helping to lead M&A strategy and deal execution. And that was an era where Facebook was heavily investing in emerging areas of computer science. Internally, AI, computer vision, sensing technologies, et cetera. I saw the writing on the wall that these technologies would pervade every sector on our planet, much like software had over the prior 3 decades. These emerging technologies would do so over the next 3 or 4 decades. And that's the thesis of Pathbreaker, is investing in deep technology and deep people that are driving these technologies across industry. I started my career as a founder and social entrepreneur. I learned capital allocation at the University of Chicago academically, and then did it in venture for 5 years from seed to Series B, and then jumped into the portfolio to get closer to engineering and product after we invested, which is the context in which I met you and your great firm VSC, and then went to Facebook. I've been working across sort of these 3 areas, and now we bring those experiences and relationships to bear for founders when we partner early with Pathbreaker.
Okay, awesome. And so let's talk about that journey. So you left Facebook, which is really a social media consumer company, and you're saying to yourself, oh, I'm going to do deep tech. Now, yeah, I get it. Oculus you could argue is deep tech. So what was that?
Very much.
How did you go from that to sourcing? How did you build your network in the early days? Yeah.
So I've been in the Valley for, at that time, I guess 5 or 6, maybe 6 years. It doesn't take long to build a network in the Valley if you're active and you hustle, right? It's an area that rewards that. Been in the Valley both operating, investing, and then doing M&A as a deal lead. So the network got pretty varied pretty quickly, and then a lot of people from University of Chicago Business School, were at large companies, and if you're in the flow, you're meeting lots of people, and people are starting new companies every day. So from the deep tech perspective, I would say, in 2015, when we started, we were one of the first deep tech firms in the Valley. And there were very few with the appetite to invest in hardware software systems. So the first investment I made out of Pathbreaker Fund 1 in January of 2016 was a robotics company called M.B.A. Robotics, and bringing computer vision and mobile robots to grocery and data collection on the shelves. So when you're one of the few, Vijay, people find you. And I was having large, very well-known venture funds send me AI deals in 2015 and 16 because they weren't investing in AI at the time, which was interesting.
Amazing. And so, well, first of all, M.B.A. has gone on to some great things. I just saw, did I see that? Was it last week?
That's right. Yeah. M.B.A. just raised a $28 million Series B, which was led by our friends at Eclipse Ventures, which I like to say affectionately is like a heavyweight version of Pathbreaker. They're $4 billion AUM, and they like full stack hardware software systems just like we do. And so they're great partners, and M.B.A. has publicly traded customers like BJ's and Spartan Nash to, family owned, $3 to $20 billion privately owned grocers that, are fighting for every dollar, and every dollar in groceries won or lost on the shelf. And so a robot with computer vision can tell you if something's out of stock in near real time relative to a human that wants to do that work but doesn't have the reach and scalability to do it as frequently as a robot in computer vision.
Got it. So for every M.B.A. out there, my guess is there's probably at least 3 or 4 more that were trying to be M.B.A., maybe another X number in China. How much is it just a founder bet? Is it too early to even test the technology? Is it all about the referrals, where that person's come from, that you know their pedigree is going to be, they're going to be able to make this at scale? Like, walk me through that.
There's no one recipe that works every time. And there's no one right way to build a company. So I always tell founders, look, if this, every company is its own snowflake, and what works for SIMBI might not work for BurnBot, which is a robotics company that's preventing wildfires that we've invested in. And so in the case of what I look for, I would say it starts with like highly specialized people. And in SIMBI's case, you had 2 roboticists from Willow Garage, which was the early Google-funded robotics think tank and not officially Google-funded, but early employees that had been really successful that wanted to build robots. And then Brad, the CEO, was a senior product manager at Silver Springs, which was a data business in the energy sector, traditional industry. And Brad was a senior PM and ran a flagship product for them. And so I think of like deep product experience and sort of deep technical insight. That's an ideal combination where hopefully someone on the team has the ability to sell to early customers as well. And when you have that combination of salesmanship and deep sort of engineering differentiation or technical differentiation and having built products at scale before, that gets me excited enough to spend time with the team. And then it becomes around, for us at least, are they building in the direction that the world is going over the next at least 1 decade, ideally over the next 3 decades? And in the case of SIMBI, getting hourly labor in some of these industries is really challenging. The turnovers can be 200%, and there just isn't enough staff to do all the work that you would need to do in an operation like this. So those trends weren't improving. And then, people are consuming more than ever before. So, we liked the direction of grocery and the need for more tools that can turbocharge the work inside an environment like that. And then, I drove out to Concord, California and saw a robot that was doing basic traversals in a grocery store. I called, 10 people from business school that were at potential customers or existing customers and did a lot of work. And I always say, we let founders take us into the industries best suited for their innovation. And we don't pretend to be an expert in every industry, but we'll do work. We'll do a lot of work quickly to try to learn as much as we can and get conviction.
Got it. And then, so talk to me, like, first check-in, where are you guys investing now? What's the right time for the founder to come to you?
Yeah, we invest in pre-seed and seed stage investments, and I try not to put the requirement, too many parameters around what a company needs to look like for us. I think by definition, we're investing in anomalies. And so we need to be prepared to be flexible to what those might look like. And so we're happy to be the first check in and lead a pre-seed round. We're happy to be the first check of a seed and help signal that we're excited about it and help the founder pull together the rest of the round, whether we're officially a lead or not. So we don't need signal from other investors to get to invest. But we always invest with friends and colleagues in whether that's other funds or angels as we put rounds together.
What are you advising founders now? So we got interest rates are higher. It feels like that's a knock on deep tech. I mean, it is a little, anything that takes longer to get to revenue seems like it's having bigger challenges. Like, is a new company that come in, do they get 2 years of runway? Is it, we change the strategy on burn? Like, how are you advising founders? Yeah,
it's a great question. So in the zero interest rate days of deep tech from, let's say, 2016 to 2022, you could build and make modest commercial progress depending on your sector, or a lot of commercial progress. It really depended. And then you would get rewarded maybe for all of that, or maybe just the technical piece or the commercial piece. And there was money for deep tech projects that was just making engineering and technical improvements over time and building a really interesting system that would one day generate a lot of revenue. And while that's still a valid way to go about solving a really massive global problem, it's much harder to raise capital in an environment where interest rates are 6 and 7% for that type of business. So for us, the change that I've been talking to all of our founders or potential investments in is if you look at like the pre-seed asset allocation or resource allocation in a plan, no longer can you get to a seed round just by making engineering progress with a ratio of 100 to 1. Maybe the CEO is spending some time signing LOIs or getting MOUs or working on commercial. That no longer really holds. Sometimes the founders can do the initial sales, but if they're not spending 50 to 75% on commercial activities, the engineering progress won't be rewarded by the time you need to go raise. So I would say, whereas historically we would have been fine with a lack of commercial orientation on the founding team, in this environment, it is a requirement for us now. And that might not be an individual it's probably not like a business co-founder, but it's at least someone on the founding team, usually the CEO, that has maybe some sales background in addition to product or in addition to engineering, or they're very comfortable in that role too. And without that, it's really challenging to show the kind of traction in this market that will allow a larger number of investors to consider investing in your pre-seed or seed stage startup.
Makes sense. And how about runway? Like if you're on a new deal, are you thinking differently about how long they need to get to the next round? I don't know if you thought differently about once you cut the check, how quickly you expect the next round to come together.
Yeah, it really depends per company. I mean, I hate to be super prescriptive in venture. I think that can lead you astray and allow you to say no to things that don't fit your box when you should do them. So I really let founders educate me, and I try to maintain an open mind as to what the right plan is. Now, if I have some thoughts on maybe risk mitigation or opportunities for them, we'll of course share them. But I want founders to filter any advice they hear from me relative to what they know that I don't. And I'm really comfortable with that information asymmetry. So all that to say, Vijay, I'm not super prescriptive. 18 months, 24 months, 9 months, depending on the founders, 12 months might be the right answer. For another founding team, it might be 3 years, depending on what they're trying to do.
And when you look at robotics now, right? So, and you probably looked at a lot of companies. Where do you see the opportunities? What gets you most excited in this space right now? Are there certain verticals where you're like, hey, that's a lot of progress? Maybe it's retail or something like Simbi. Looks like there's things happening here. Maybe there's not the need for 20 more companies to be funded in this space. Here are the greenfield opportunities, or how do you think of what's your thesis in 2023, 2024? Yeah,
absolutely. I think robotics is arguably the most interesting place to be investing right now. 75% of Pathbreaker's investments touch hardware. It's really hard to solve globally important generational problems with software alone, I would argue. And so if that's your goal in venture, is to invest in the generational businesses that are 10, 20, 30 Xers, I think there's 10, 20, 30 plus $1 billion companies. I think there's a whole field of hardware oriented businesses that, eventually might have monopoly style potential, or just without a monopoly, just would capture so much value being full stack. And robotics to me represents an opportunity to build those kinds of full stack value capture businesses across industries. So we're investors in a company called Hyphen, which builds robotic make lines for the restaurant industry, BurnBot, which builds robotic systems for wildfire prevention, Inevitable, which builds clean propagation systems for global ag, both field and indoor, Presso, which builds clothing care robots that dramatically reduce the carbon footprint. So right there, that's agriculture, laundry, wildfire, and restaurants. And I'm not an expert in any of those industries, but I'll tell you what those founders are. And I like following them into those industries that might be overlooked, might be traditional, and historically don't have the same kinds of balance sheets as a tech company would to make investments in these areas. So often we end up with competing with very few people for a long time. I think robotics is, while it's challenging, it's certainly challenging, and it requires more capital up front. Over the long term, I don't think as much. I would argue it can be more capital efficient than a software business. and we've invested in 30 robotics companies. And only one software company for robots. So I think that's the other thing. People like to dabble in venture in software investment horizontally across robots. We've invested in an incredible team that's doing that called Foxglove, which with Adrian McNeil, who was at Cruise and built their infrastructure for visualization for many years. But that's I think a lot more challenging to invest in software for a robot than it is go take a full stack problem in an industry.
Wow. Got it. And as you see, like the last 4 years have been crazy, right? We've had a pandemic. We've had the markets provide too much cash and too little. You've had people staying at home and not going back to work due to the pandemic or possibly stimulus, depending on who you ask. That drove a labor supply shortage, which sounds like is getting filled a bit in the last year in hospitality and some other areas, maybe not fully. Where does this fit in terms of the era of robotics? Is like, what are the tailwinds here? And like, and I just want to kind of have you like reflect a bit on where we are. If you're like, look back at you're going to write a book on this one day, and what will this era look like? And what will have sort of moved the needle?
So I think of robotics so far as being in two eras. From the applied side. So, and I'm going to start my era when Pathbreaker got going in 2015. From 2015 until COVID, robots were relegated to the innovation groups, and nothing wrong with innovation groups at large Fortune 500 companies, but that's where these products sat. And in the history of our planet and species, you couldn't evaluate, if you were a VP or an executive at a large grocery store or Procter & Gamble or John Deere, you couldn't evaluate a robot to solve your problem prior to maybe 2013, 14, 15. So now you have this opportunity to solve your issue, solve whatever problem you're facing with a robotic solution or a deep tech solution. But no one in your organization knew how to evaluate that, how to procure it, or how to support it. So the innovation teams was era one in robotics, and that was 2015 to 2020. Okay, then COVID gobsmacks all of us, punches us all in the face, and we're left with massive shortages. Labor stayed home, and then at the same time, we were facing a recession with pressure to still grow companies. So you had all these factors in place. It really provided, I think, an ideal. Two things happened. One, you had to consider automation solutions to survive. You had to consider digital solutions, remote solutions, automation solutions to survive as a company. And then you were forced to say, all right, the past 5 years we've been looking at robots in our innovation group. Looks like they work. Now we no longer have the luxury to keep evaluating and getting data. If they work, they work, and let's deploy them. So we've seen now this phase two is a move from the innovation groups to the C-suite and evaluating robotic solutions at the C-suite level to then, with much less data over much shorter periods of time, decide to scale, to reach chain-wide deployments or scale deployments within a robotics startup. And we've seen that, in this year with M.B.A announcing a 237 chain-wide expansion with a customer called BJ's Wholesale Club, which is in the category of Sam's and Costco and BJ's. And BJ's is a $9 billion market cap publicly traded company. And the executives were really supportive and blown away by the data and said, yeah, absolutely. This works at 15 stores. It's going to work at 237 stores. And so time to roll it out. So that's, I think, phase two now is as C-suites are being forced to grow revenue and evaluate those constraints they're facing with labor and supply chain. Robotics and automation are solutions for that. And the data supports that these robots can work at scale.
Yeah, totally makes sense. And we're seeing it every day. Like you go to SFO airport, you see Cafe X, the robot coffee maker. And I feel like it's, you're going to start seeing more of that in retail stores, Walmart or wherever where you see it. It's just interesting. Like it seems like the visual moment, and at least on the enterprise side and consumer side, is coming and more effective. How do you, how are the companies that you work with thinking about selling when in some ways these jobs, these are these are going to replace some human jobs, right? Some cases, right? And labor supply shortage is one way, but in some cases, they're going to be humans that used to do this job, and now it's not. How do they have challenges with the message to the customer, or is it just like the shortage is so bad that it doesn't even matter anymore? Because if you remember, like 2016, there was this, like right after Trump got elected. I don't know if it's coincidental or not, but like all of a sudden everybody was worried about robots taking jobs. I don't know if you remember this. It was like the same exact.
I remember this vividly. We lived it in 2015 and 16. This was the fear. Frankly, this was a fear of mine, and I wouldn't invest in a startup whose value proposition was solely labor replacement. Going from 3 employees with our robot, you go to 1. I wouldn't invest in those types of companies for fear of A, that being really hard to deliver on, and B, that's not the kind of company that I want to go build. What's happened instead is that the challenge has really been meeting demand or getting the work done that needs to be done. And so companies are buying robotic solutions not to replace labor, but to meet production that otherwise is throttled because they don't have enough labor. So in the case of gray matter robotics, they build an autonomous sanding and spraying and finishing solution for US manufacturing. And they have a customer that makes a very popular consumer product that said, we've got demand to make 3 times what we're able to per week because we can't get enough labor in the production line to do these dirty, dangerous, sort of dull, rote jobs. And with gray matter, they can now meet demand. So, that's been really interesting. I think robotic solutions that just perform one task over and over again, well, that's missing an opportunity to capture a data set that can then be sold to that potential customer or to someone else. So I think when you have hardware in a customer's location, it opens up myriad opportunities for future products and opportunities to monetize. And if that hardware and robot performs and matches expectations, it's rare that it gets removed because the relationship between the customer and the startup ends up becoming so strong. And there's so much trust there because there's been a lot of people that have tried to deploy robots and hardware in environments that haven't worked. When you find a team that can perform and build product that doesn't fail, man, they just have continuous opportunities to solve problems for their customers.
Yeah, makes sense. And so robotics is the core of what you're doing, but there are some crossovers with other areas like climate. So can you tell me a little bit about some of the companies that you're working with in that space, and I don't know if you have any particular other additional thesis ideas there, but love to hear more.
Yeah, absolutely. I mean, when you're talking about technologies, by definition, they're horizontal across use cases and industries. And so we've made probably 9 investments that could be considered climate investments. We led the pre-seed round of Running Tide, which has been using automation solutions to grow carbon sequestering oysters, as well as kelp to sequester carbon in the open ocean. They work with Microsoft, Shopify, Stripe, Chan Zuckerberg Initiative, and it has raised $70+ million from Lower Carbon and Founder Collective and others. And we had the pleasure of leading their pre-seed. You can't sequester carbon with droves of people out in the open ocean. You need automation and machine vision, AI, and automation solutions to do that. TreeSwift is an example of a company out of the UPenn Grasp Lab, which a team of 3 PhDs had realized that you could use drones and sensors deployed below canopy in a forest and generate a data set of every tree on the planet, its health, size, value, relative to the state of the art today, which is crews of people that literally walk forests with tape measures and clipboards. And so if you're trying to value a timber plot for a timber owner or for removing carbon, we can do that at a scale and speed that's just unprecedented today. All the way to a company called BurnBot, which I mentioned earlier. BurnBot's based in San Francisco, and the CEO has lived in Tahoe for the last 10 or so years. He was a successful entrepreneur prior. Today, that if you want to prevent a wildfire, you have to use a crew of people with torches that after clearing a brush manually, walks a line with a drip torch and prays that gusts of wind and weather conditions stay such that the fire doesn't escape and explode and dramatically, torch up millions of acres. With that technology, drip torches and prayer, you can't burn preventatively if a forest is near a school or a neighborhood or power lines. So BurnBot's built a robotic system that lays these charred burn lines that eliminate fire fuel. They sort of paint a field with these lines, and then a drone comes in and drops an incendiary ball that burns the middle. And about a month ago, we announced a partnership with PG&E, where PG&E is using BurnBot to use preventative fire next to power lines and highways and schools. It's smokeless. We extinguish the fire immediately in the system. So there's no embers. It's near smokeless, and you can burn year round. That's a phenomenal use of automation, robotic, computer vision, hardware technologies. We're going to be able to potentially save millions of acres. We have 20 million acres that should be burned today, and today we only do 10,000 a year. Those types of technologies get me fired up when you take deep tech and now you're using it to literally save the planet.
It's amazing. And sort of, let's talk a little bit about this process now that these startups are going into fundraise. So is there any specific metrics you could say, hey, this is generally where we see Series A milestones changing? Are companies in the portfolio raising the Series B right now? Are they waiting? I think founders are very curious about this. We hear it all the time, right? What are the milestones in today's funding environment? It seems like there's a fair amount of capital at seed, not that every company's
right.
getting funded, but the A and B and C's are totally different stories.
100%. I mean, I think many of us had companies raise hundreds of millions of dollars, almost $1 billion in 2021. And Series A, B, C, D capital was prevalent. 2022, 2023, the B, C, D capital is dry, and A's are really tough. And valuations are back to the 2015, 16, 17 era. So it creates a bit of a challenge for pre-seed and seed. Should you be paying, if with capital and competition for deals, should you be paying Series A prices for pre-seed risk or seed stage risk? I don't think that's healthy for anyone. What metrics does a startup need right now to raise a Series A? I think to get the conversation going, you need close to $1 million ARR. That's not going to get your round done, but that's going to get the conversation started with a great venture fund. That metric needs to probably have been achieved over the past 12 to 18 months. And the market needs to be really interesting and aligned with where the world is going, both from a macro and microeconomic perspective, in my view. If that holds, a great Series A gets a term sheet in 6 weeks. A couple years ago, it was 1 to 2 weeks. So it's taking longer. It's taking probably 3 to 5 times longer if it's going well. And if you're raising while you're approaching $1 million, but you're not quite there, it might be 3 to 6 months. It's tough. I'd say the only way anyone fails in our world is if people give up. So if you have conviction, if your existing investors are going to support you, don't give up. And frankly, a flat round is the new 2x up round. And unless you're growing really quickly, so let's talk about Series B and C right now. Most of those rounds are being led by insiders. Full stop. Most of those rounds are being led by insiders. And it's, if you don't have insider support, that's really tricky. This dynamic where the insider support takes the shape of a smaller price round or a convertible note, we're seeing lots of structure, so tranches happening, where 10% of the ideal round size gets put together now. And then if 1 or 2 salient milestones are achieved, there's a big slug that, 20 to 40 million comes later. The other thing I'm seeing, man, is, I don't know if you've seen this, Vijay, but at the Series, even A plus, but certainly the BC is the FANGs come out with the later stage investors. And there's people are trying to buy 20 to 40% ownership of companies. because they have the fund sizes to write the check now at a valuation where those percentages are possible. This is a new dynamic where they're taking a lot more time to do a deal. Okay. So instead of diligence happening in a week or two, a Series B is taking 3 months. Now, after they've done 3 months of work, they have a ton of conviction. Maybe they're the only one firm that's done that kind of work. And so with all that conviction and a big fund size, they're dropping, a large check and wanting to do it all.
Yep. I mean, we're seeing all kinds of things. We're seeing a lot of much more pressure on the founders and leadership change than ever before, and maybe in 10 years, because milestones are so much more critical. And saying promising what you said you're going to do at the fundraise to where you get to is much more tightly managed. The tranche thing is interesting because that's like old school 2011 stuff.
That's right.
Or 2004 stuff or 3 stuff, right? The tranche, because that's how much the market is getting nervous, right? Or the investors, I'd say, to make sure things are happening. And also, let's be honest, we read a lot of articles about people misusing money. So there's probably some pressure too on the LPs saying, hey, before you cut that $100 million check, right? Let's make sure things. So, of course you're seeing down rounds too, right? That's right. In deep tech is happening.
In some ways, deep tech was insulated more from the down round than SaaS, I would argue, because SaaS got so inflated in 2020, 21, and 2022. Deep tech didn't really see that. We saw appreciation in value of companies, but not to the extent that the SaaS multiples exploded. And so the compression has been severe in SaaS, I would argue, but not as much in deep tech. It's come down a little, but not quite as severe.
Yeah. Again, it's company by company and who raised how much at what valuation, right, in the last couple of years. But that makes sense, and that's helpful, I think, to the founders that watch our podcast or hear it. Let's get into a couple things, maybe a hot take here. I think that's super helpful for the audience. What are you not investing in right now? And I think you'd mentioned it was probably one of the more popular trends.
We were investing in AI, applied AI, from 2015 to 2022 pretty aggressively. And that strategy made sense when AI was scarce, I would argue, at the application layer. So we've had 3 AI exits already. McDonald's acquired Apprente, which was using conversational AI in the drive-through. Reddit acquired SpikeTrap, which was using AI for sentiment analysis and real-time conversations. And then Relativity acquired TextIQ, which was using AI for privileged review classification in legal matters. And so we've, as a firm, Pathbreaker's made money in AI, but it was predicated on this idea of scarcity, where you needed PhDs that represented maybe a handful of people in the world that had worked in their particular field of AI research, that then could get access to training data, whether it's through a customer or some other means, that then could sell an enterprise solution to solve that problem with those 3 components. Well, what OpenAI has done is made the PhDs and the training data available via an API call, essentially. So you sort of have a PhD in your pocket if you want to use AI to solve a problem. So you no longer are burdened by being able to recruit from Stanford or Google to find the PhDs that can do the work to build or buy that solution from a startup. So I think generative AI right now, at the application layer at least, is a minefield. It's very hard to find teams that are actually doing something novel. And instead, it's it reminds me a little bit of Amazon Web Services or Google Cloud. That was innovative at the time. 20 years ago, if you know how to put together a data center, that was the strategic advantage. Now it's not. You just use AWS for storage and compute. No startup's differentiated for using AWS anymore. So I don't think a startup's going to be differentiated for using large language models, unless there's something else that's scarce in their system. So yeah, we're not really investing in generative AI applications. That said, I made one exception for an incredible team out of App Dynamics called Apt Edge. That's getting access to disparate data sources and giving customers what they want, which is really the answer. So they've trademarked Answer GPT, and they're building an answer solution And these were engineering and product leaders from App Dynamics, which Cisco acquired for $4 billion. And they're, specialists, experts in their field. But absent that sort of unique unicorn style of ingredients, it's not super differentiated in my view to be investing in generative AI.
How about, okay, makes sense. And then how about, there's a lot of money that's been raised for AI funds. Seems like a lot of people are doing like the picks and shovels businesses, some infrastructure companies. Like, how many of those are going to become, how many of them are there need to exist, right? Like,
I think the most interesting places for Pathbreaker to be investing in AI is on the hardware side of AI. So we're invested in a company called Fathom Radiant, which has been working in AI hardware for a long time, 6-7 years. The constraint to AI right now is NVIDIA GPUs and GPUs. So for a team that's building novel AI hardware architecture, that's really interesting. And so as a firm that spends 75% of our dollars investing in hardware, we're a great partner for big, AI hardware swings.
Very interesting. And I think kind of just to cap it off, like, as you're thinking about your career, you've been building this from investor to operator to investor. What are some of the, personal lessons now, get to that part of the discussion? What are some of the, maybe just to help with sort of inspiration? It's a tough time right now to be a founder. It's tough. Maybe as you build your career so far, best advice you were given?
I think my advice to founders, to really simplify it, is to trust yourself. You're going to have a lot of people in your ear as you build a company. Investors will have access to your ear. Sometimes they'll have influence, but your business better than anyone else around you. You have more data about the customer whisper, the competitive concern, interpersonal dynamics amongst your management team that might prevent some product idea that you've heard from an investor or an advisor. You're in the best position to make these operational decisions. I always tell founders, I'll ask a lot of questions. I'll share from my experience. But if you end up implementing 0% of an idea that I've shared, I'm going to assume that's the right answer because you have the data. I don't feel like founders need to follow venture capitalists' advice. I feel like founders need to listen, they need to sample, and then they need to make the decision. And sometimes they follow the advice because they know that's the right answer. And other times they don't because they also know that's the right answer. I'm very comfortable with that level of trust. If I've done my job and backed the right founders, they're going to do well in this area. And I think founders should just trust themselves, trust their gut on people. And at the end of the day, I think a venture capitalist's job is to help founders realize their full potential. We should clear paths. Pathbreaker wants to back founders in pursuit of generational impact. They'll go off path to do so. And if we make a contribution, we're help clearing paths through bringing more capital into the company, through introducing a customer, introducing a great hire, a partner. And sometimes working across the cap table to really rally behind a founder or bring in additional investment or be supportive of the founding team. So I think my message to founders is just they're in the best position to know what the company needs. Seek input, but at the end of the day, it's your company and we have to trust you. So trust yourself.
Yeah, that's a great piece of feedback. So Ryan, again, thanks for the time today. Just to end it off, who else should we get on the Climb podcast? Who are some folks that inspire you in this work?
In climate, you should have Stephen Chen from TreeSwift on. Stephen has a background as a options trader in ag, and then a PhD in computer vision at UPenn's Grasp Lab. And what they're doing in forestry is completely novel, under the radar. Lots of interest from investors in what they're doing, but most importantly from customers. And they've grown 25x year over year, and are solving really hard technical problems in pursuit of generating this data set of forestry for both timber and carbon. And then I would say on the robotics side, you've got to have Brad Bogolia from Symbi on. Brad has deployed and built more robots in service robotics than I think anyone, where robots are operating during store hours around customers, as well as working with employees and generating a novel data set. M.B.A has robots operating right now, as you and I are speaking, on 4 continents and across half the United States. And that kind of scale of delivering a full stack robotics solution with AI and mobile robotics is really hard to do. And so he'd be a great person to chat with.
Amazing. Ryan, thank you so much for the time today. This is great. Everybody, check out Pathbreaker Ventures. If you're building an awesome company in robotics, he's the man. Looking forward to doing more deals together and appreciate your time today.
Well, that's all for this week's episode of Climb by VSC. Thank you so much for watching and listening. Special thanks to H.E.R.O for their help in producing and promoting this episode. To visit any part of today's conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for posting these every week. Lastly, if you've listened this far, please leave us a rating on Spotify or review on iTunes. It only takes a few seconds, really helps us out, and as far as I know, it's still carbon neutral. Well, that's all for now. We'll see you all next week on Climb by VSC.